Welcome back. We're continuing our coverage here at Davos 2023. Joining us now is the former Governor of the Reserve Bank of India, Raghuram Rajan. Dr. Rajan, always a pleasure. Many thanks for joining us here in Davos. You know, we've got many indicators at this point in time, lots of surveys, lots of research suggesting that we are going to be seeing growth slow down significantly through the course of the year. In fact, PwC's 26th annual CEO survey, which was put out just last night, suggests that this is the most pessimistic that CEOs have felt in over a decade. I mean, it's hard to believe that they didn't feel as pessimistic through the course of the pandemic and they feel as pessimistic as they do today. In your conversations, in your readings of data at this point in time, what's the expectation for 2023?
Well, you've got the expectation right. It's doom and gloom. But when everybody's pessimistic, it probably means that there's some hope that things will turn out better than people believe. I mean, what's the reason for pessimism? You've got central banks raising rates. You've got still no indication that they will pause quickly. They probably will go on for a little while more. Rates are at the highest they've been for decades. And of course, there's a lot of leverage around. So corporations will probably see a reduction in their profits. Can they pass through, into higher prices? That'll be a problem if they can, because that's the inflation that the central banks are trying to combat. So there is this fight. Eventually, central banks will win. The question is, will they win with an economy which is still, chugging along, or will they sort of create a recession? My sense is, if it's a weak recession, a mild recession, doesn't matter that much. They can cut rates eventually. They probably will sometime when they see that happen. And things will come back up. The real question is, do you unearth more problems as you do that? Financial sector problem or something like that. Remember, we haven't been in a situation where we've had so much leverage and an increase in interest rates at the same time.
What do you make of what's happening in China at this point in time and what it could mean as far as global growth is concerned?
Well, I think China is recalibrating, right? First, of course, the zero COVID policies, but also a lot of their policies over the last few years have been predicated on they conquered COVID and they're doing the right thing, so acting against the private sector, trying to straighten out their real estate problem. And I think they really bit off more than they could chew, including some of the relationships with neighboring countries as well as with Western democracies. So I think they're backpedaling on some of this. I don't think they've changed their mind. It's all in the mind of Xi Jinping. But I think what they've done is they're recalibrating just to stabilize their economy. You can't fight so many battles on so many fronts at the same time. And I think when they recalibrate, my guess is for a while we will have some respite. But after that, perhaps we'll be back to trying to decide what is China up to. Yeah,
well, those are two of the likely positive surprises you spoke of. One, of course, the war ending between Russia and Ukraine and what happens in China as they recalibrate. What could the other potential upside surprises be that you would watch for?
Well, I mean, certainly from India's perspective, we would like commodity prices to be lower. I think right now the guess is as China comes back up, commodity prices will, go higher. And that will be a problem for India, which is already running a fairly significant current account deficit. The price of oil, as you know, plays an important role. But I think if commodity prices stay lower, then, to some extent, some of our inflationary issues also become less important than they are. Our core inflation is still something to worry about. But that would be a boost to Indian growth. I think the other place where India would benefit tremendously is if we saw, more openness to globalization. One of the places we are doing quite well at this point is in our service exports. And if the world was more open to globalization, and if we could use the G20 presidency to push for greater openness towards service exports. And there are many impediments to service exports, many more so than manufacturing exports. That could be something very beneficial to Indian growth. So I think that certainly some thinking about how we grow in the coming years would be useful, and we could benefit from this moment.
You talked about fragmentation and that being a big risk. Your former organization, the IMF, including the World Economic Forum at Davos, have put out reports talking about how that is likely to be the single biggest risk factor that the world is dealing with at this point in time. I mean, outside of trade flows changing course on account of this reshaping, this closing down, this insularity that we've spoken of, what could a more fragmented global economy really mean? What are the long-term implications of that we're not fully acknowledging today?
Much higher cost world economy, much more inflation. I mean, one of the factors keeping down inflation has been competition between countries, competition between labor forces. Think of higher costs, right? Every country worth its name is trying to build chips today. It's not just the US, not just Europe. India is trying to build chips. Others are trying to build chips. What this means is down the line we have a glut of chips. But a tremendous amount of investment has gone into chip making. The world doesn't need so many chips I mean, this is one of those, you go from nothing to a real huge glut. But every country thinks it's important for its security. That's an example where the lack of trust between countries creates overinvestment in certain areas. Now, I do think that one of the areas we need a lot of cooperation is in green investment, in new green technologies, in green financing. And unfortunately, this fragmentation makes it harder when countries view each other with great suspicion. When countries are, applying protectionism, the US in this case with the Inflation Reduction Act, to green manufacturing, green technology. The US should be saying, we want this to be something for the whole world. But instead, you're trying to sort of foster your own industries. And every country is doing that. There's not just the US, not just India. And so it's important to bring down this new sort of nationalistic, protectionist wave across the world. Otherwise, we're in for a much higher cost, much slower growth world economy.
You talked about how central banks must focus on their core objective, their key objectives, and not take on any more obligations. How complex has it become for central bankers? And do you believe that 2023 is going to be far more complex for central bankers?
Well, I think central bankers are back in an area that they understand, which is fighting high inflation. I think when they were trying to push up inflation, because inflation had gotten too low, they were in an area where A, they didn't have tools, B, they didn't really fully understand it because they hadn't been in that place for a long, long time. I think now, I mean, they know they have to raise interest rates. They know they have to be careful about doing too much. And they just don't know exactly where that is. So there will be a little bit of trial and error, which is why most people believe they will go too far. But that said,
do you believe they're likely to go too far at this point?
I think at this point, they will. Partly because what's happening is at the earliest, as soon as people think the Fed is on pause, immediately the financial markets seem to want to take off. And so the Fed is fighting this problem, which is that financial conditions relax as soon as it says pause, which means it probably has to go a little further than it wants to because it doesn't want financial conditions to relax so much.
Are you surprised by the resilience that we are seeing in the labor market?
Yeah, I mean, I think part of it is many employers basically think, if I let go my employees right now, I may not find them back. So they have to be really convinced we are slowing down before they let go employees, given that they had such a hard time finding employees in the recent past. So it may be that we have a little bit of a cliff effect. Nobody sort of fires until they see some people firing, and then they fire their own people. And so that is the worry that the Fed has, that nothing happens and then a lot happens. And we get a much more of a slowdown than they bargained for. Again, I hope we don't get there. We're seeing tech layoffs. We're seeing some layoffs outside. I suspect there will be more before the Fed feels comfortable in pause.